macro market trends, stock selection, ETFs, options, just some of the topics covered in Cook's Kitchen. Are portfolio managers irrational? Well, Kevin Cook seems to think so, and he's here with us now to explain why and how you might be able to even make some money knowing that concept. So the first question is the obvious one that I have to ask you. What do you mean by that remark?
So, we know that a lot of big investors make money off the fear and greed.
Right.
Warren Buffett has a famous quote, buy, when others are fearful, sell when others are greedy.
Yeah.
But this is happening on a continuous basis. Markets are not efficient. They are very inefficient. And so sometimes very good stocks get trashed. Portfolio managers run for the hills, they take their profits, and then they go into a wait and see mode. And you see incredible value in some stocks. So I want to show you three that we've actually played here in the past few months that have worked out terrific.
So the irrationality of their thinking lies in the fact that they run and hide sometimes?
Exactly,
okay.
When there's still value and opportunity. And that's what you have to recognize. Sometimes when the big guys sell, maybe there is something happening, and that's when you want to be out of the name, but then you reevaluate. So I'm going to show you three stocks where we did this.
Okay.
VRTX, a biotech company with a hepatitis C drug, was one of my first picks for Tactical Trader, the new portfolio, in early December. And you can see what happened to this stock in the fall. They took it down from 50 all the way down below 30. And I looked at the company and I said, they're going to be extremely profitable with this new drug. They've got the only successful hepatitis C drug, and they were going up against Merck, who had a similar drug, and they clobbered them in sales, and the projection was they were going to continue to do that. So I said, there is value and opportunity here. The reason that the stock got trashed, I should emphasize that with all these, why it got trashed, why I saw value in the strategy I used.
Yeah.
VRTX got trashed because investors saw, well, there were going to be all kinds of new competition with hepatitis C drugs. And VRTX had an old style drug that used interferon, which is a heavy dose of medication with a lot of side effects. So people were waiting for the next generation. But the point is that this was a hepatitis C drug in the commercial market, working and profitable for the company, and going to be so through 2012. Okay. So that's where I saw the buying opportunity. We bought April 30 call options, and we doubled those. Made 100% on those options. As you see, the stock crept back up towards 40. And they now have a cystic fibrosis drug. That's another thing with a biotech. You got to see, well, what kind of pipeline do they have? They can't be a one-drug wonder.
Right.
Okay, so let's look at our next one. Here we go, CME Group. Here was another one.
Familiar name.
Yeah. This one just kept selling off in the fall, especially after the MF Global catastrophe. So there was concern about, well, what's CME's role here? What's the responsibility? Will there be new regulatory, legal constraints on CME? So big investors who own this stock, because it's a high-priced stock, are like, well, we better take our profits here. So they didn't completely trash it, but they definitely were not buyers. And this stock got all the way down to 225, and I said, this company is still an earnings machine. I mean, CME is the monopoly in the futures business. And they do so many transactions. They 11.6 million contracts a day trade, and their average revenue per contract is like 80 cents. So they're just a cash generating machine. Well, we bought March 260 calls, out of the money calls. I usually don't like to buy the out of the money calls, but here on an expensive stock, we paid $2.50 for the March 260 calls in early January, and you see what happened. After their earnings report in early February, CME just vaulted. We let those go too soon. We had a triple in those, 200% gain on our money in those options. People who've hung on to them are seeing 6 and 7 times their money, because you can see what CME did here after their earnings report, just launched from 240 up to 280. All right, next one is Coinstar. Now this one I did not trade for the Tactical Trader portfolio, because I actually bought this in October after Coinstar got trashed. Remember how Netflix sort of did themselves in when they raised prices,
yes.
2 different websites, and made everything confusing for their customers? Well, in October, Coinstar came out with pretty solid earnings, and they raised their price 20 cents on a DVD rental. And what did everybody thought it was another Netflix, so they took the stock down $10. I bought it at 46, and I said, you know what, this model is still intact. They raised 20 cents. You could raise $1 and people will still rent Redbox.
Yeah.
So Coinstar is a company, Redbox obviously their main business. And why is it? Because people like to hold a DVD in their hand. Not everybody's at home streaming online, right?
That's true.
They like to go to the fancy kiosk, play with it a little bit, pick out their movie, press the buttons, take that video home. It's an event.
There's something about looking at that case.
Yeah, it's just fun. That's how it's the whole entertainment experience. Hey, look what I brought home. I brought home a movie for us tonight, honey.
Right.
And that worked. And I said, they could raise it 20 cents every quarter. This should only add to their earnings, is what I said. So I took some pain on this one because Coinstar went down to 40 a couple of times. But then you can see what happened here. After the last earnings report, they blew it out. They've got a deal with Verizon. They bought another DVD kiosk competitor. And I took my profits to 57. The stock went up to 60 a couple days ago. It's trading back around here now, and I might buy it again.
So from your perspective, was the portfolio manager irrationality evidenced on each of these three?
Yes, absolutely. That there was still great value and opportunity in these names, but because of a news event, and not really, sometimes it's a small earnings miss, sometimes it's a news event. In the case of CME, it was more like heavy news flow about MF Global. In the case of Vertex, it was, oh my gosh, somebody else might have a drug to compete, but Vertex still had the earnings. And in the case of Coinstar, it was, oh no, they're going to be another Netflix,
right,
which was not the case at all.
Okay.
So those are the three that we made money on. 2 in the tactical trader portfolio. Coinstar was my own.
Now, is there something more specific on your radar at the moment that fits into this pattern?
Funny you should ask. Now, this is a smaller company. I want to warn everybody. The ones we've looked at have either been large caps or good-sized mid caps. This is Twin Disc, $350 million company. They make clutches and power takeoff equipment. So think about mechanical power transfer from everything from a tractor, in the farmer's field to drilling rigs for petroleum E&Ps. So just think clutches and power transmission, mechanical power transmission in all off-road areas and industries. So Twin Disc, here's one. You can see the big selling a couple weeks ago here, and it was a small earnings miss. So here we have an earnings miss. Does it take away from the earnings growth? I don't think so. And I could be wrong. We're still early in this one. We bought the stock for a tactical trader just below 33. And I see some value and opportunity here. The stock could still come down and drift around 30 bucks, and I would buy more because this is a small company with some powerful earnings growth and in an expanding market. And we've got industrials on fire right now. The global economy is still intact. China's going to re-stimulate. U.S. manufacturing and housing are on the rise. So for a small company like this, I see a lot of potential, and I think this is one you buy also for the long term as long as their earnings growth story stays intact. And that's what we keep an eye on here. My risk in this is maybe I'll risk down to $28 in this trade, but and I'd still be a buyer at 30.
Okay. He is the generally always rational Kevin Cook, and you can follow him in a couple of different places. His writing is always on Zacks.com. You can link to that right off our homepage. The nice full articles. They change a few times during the week, so you may want to check back to the website often. And you can follow him on Twitter at Kevin B. Cook. With Kevin, I'm Terry Ruffalo.